Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about VanEck ETFs later on, but for now, let's get into today's interview. Very pleased to welcome back to Forward Guidance Lou Crandall, Chief Economist at Wrightson ICAP, and Joseph Wang, author at FedGuide.com. Our conversation a little under a year ago was very, very deep on the plumbing, and I'm so glad we can do it again. Guys, thanks so much for coming back. Welcome.
Thank you.
Thanks so much for inviting us.
I first want to talk about the draining of the Fed's reverse repo facility, this giant pool of money, most of which has now flooded out since we last spoken. Lou, I want to ask, number one, why did that happen? What is it? A kind of intentional action by the Federal Reserve, or is it just the way the mechanics work? And number two, what are the consequences of that giant pool of money moving out of the Federal Reserve into the broader market?
There have been some surprises in the way this has played out. A year ago, I think most of us thought that the decline in the RRP facility would be driven almost exclusively by the decline in the Fed's balance sheet and the increase in the supply of Treasury bills. And there would be a natural market response to those flows, but those would be the key factors. Turns out there was a third factor that surprised me at least, and that is the really remarkable growth in money fund investments in the private repo market. Money funds have very aggressively diversified their investment capacity to provide repo funding to a broader range of customers, and more importantly, on a larger scale. And the result is that because they've been able to diversify away from Fed RRPs, the repo facility has actually fallen faster than the Fed securities portfolio. And that was not something I had anticipated a year ago. What that means is, the RRP facility grew because the Fed's balance sheet was providing so much liquidity that much of it spilled out of the banking system and spilled into money funds through their RRP investments. The exact opposite is happening right now. Some of that cash is spilling out of money funds back into the banking system, where frankly, nobody wants it. Banks have average reserve balances have been trending around 3.2 trillion for a number of quarters. And banks had seemed, content with that. That was more than they needed in the long run, but it was clearly not something they were uncomfortable with. With the money spilling back out of the RRP facility, reserve balances have risen to the 3.5 to 3.6 trillion range. Estimates vary about what the long-run target for reserve balances is, but it's under 3 trillion. Estimates vary, 2.5 to 2.8. I'd be at the high end of that range. Some people are lower. But clearly, 3.6 is not the target level. And the fact that reserve balances have been rising as money funds have diversified away from the RP facility, is a reason to continue the runoff at full speed for at least a few more months here. One of the things that may be driving this, and this is speculation, no money fund complex has said this to me, but now that we're getting to the point where Fed officials have some visibility about getting the RRP facility down to bare minimum levels, money funds are, there are a variety of combinations of market dynamics that might lead to that, all of which are driven to some extent by the Fed's balance sheet. We don't know exactly what the sequence will be, but if the Fed says it wants to get the RRP facility down to minimal levels, it can succeed at that at some point. So if you're a money fund, you're looking at a world in which rates are going to reach levels, spreads are going to reach levels at which the RRP facility is unattractive. That's sort of definitionally what a minimal level means. And if that's the case, you have a very strong incentive to source additional investment capacity now to make sure that when that day comes, you've got an adequate investment counterparty network to place all the funds that you want. And so they actually have a strong incentive to seek out counterparties. This isn't just driven by the fact that leverage investors are boosting their demand for funding. Money funds have a very, very strong incentive to stay ahead of the curve and to make sure that they are ready for a world in which the RRP facility is an inferior investment option?
Some of that I think I understood, because when the Treasury issues more bills, the yield on those will be higher above the reverse repo facility. So that will be attractive to money market funds invested in the reverse repo facility. So they'll pull it out of the reverse repo facility, put it into the Treasury bill market. A lot of that, I'll have to be honest, went over my head. Joseph, could you explain a few of those concepts that Lou just broke down, please?
Joseph, one of the key points that I should have mentioned, and I would ask you to mention, is the fact that onboarding repo counterparties is very time consuming and burdensome, and it's why you need an early start. Take it away.
Definitely will mention that. Well, first, I would just harp on Jack's point about the bill issuance. As we know, the repo facility was over $2 trillion last year, and since last June, declined precipitously. Now, there are two reasons driving that. As you mentioned, Jack, we saw the US Treasury issue a tremendous amount of Treasury bills. In fact, as we all know, the US Treasury has actually shifted the composition of their overall outstanding to be, I think, about 21% bills. So slightly above where their self-imposed guidances are of between 15 and 20%. And that tremendous amount of bills has cheapened bills. So bill yields rose above the expected path of policy. And that was really attractive to money market funds. And so money market funds were buying a lot of bills. And Jack, as you've also covered in many of your FHLB episodes, the FHLBs have also issued a lot of debt, and that's attractive to money funds as well. And the more interesting recent development is, as Lou mentioned, that there's been a tremendous increase in repo investments by money market funds. Now, if you're following along at home, there's actually really good public data about this. It's called SOFR volumes. SOFR is a basically overnight Treasury-backed repo. And if you look at that time series, you can see that it's basically taking a stepwise rise over the past few months. It's really surging to around all-time highs. And a big part of that is that money market funds, as Lou had mentioned, are making more investments in private repo through a wider range of counterparties. As Lou mentioned, so I used to work on the money market SESCA on the New York Fed. It actually does take a really long time to onboard new counterparties. There's a lot of paperwork involved. It takes months, actually, and capacity. So if you are a money market fund and you want to, say, invest in a new dealer, have a new relationship, it takes a long time to onboard that. So this is something that they have to set in motion far in advance. And it looks like they've been doing this, because if you look at SOFR data, if you look at NMFP data, so what the SEC publishes on a monthly basis, you can see that they really are increasing more repo lending. And I think a big part of that is just there's more repo demand. So when I look at the dealer balance sheets, so as published by Fed data, you can see that the dealer seems to be doing more net repo lending. And I suspect that has to be with the rise in, relative value trades on the hedge fund community that we've been hearing so much about. And that looks like it actually continues to grow, surprisingly. It's already quite large.
Very interesting. So MMF money market funds, they can either buy assets, FHLB debt, Treasury bills, or they could lend in the secured repo market, either to the Fed, not that the Federal Reserve needs to borrow, of course, or they could lend to private borrowers in the repo market. So it sounds like Lou and Joseph both are saying that the money is flowing out of the reverse repo facility to lend to other private counterparties. Lou, why is it that there is an increase in private demand for private sector financing in the repo market? Joseph mentioned it's used to fund the basis trade, which we can get into. How much of it is that versus other factors, do you think?
It's very hard to say. The basis trade, as shorthand for relative value trades in general, is clearly a big part of it. But repo data is becoming more available. It's still a rather opaque market. People take a stab at these things. For anyone who wants to dig into the basis trade, there's an absolutely fascinating presentation at the latest quarterly refunding by the Treasury's Borrowing Advisory Committee. Their quarterly reports to the Treasury just keep getting more and more interesting as the years go by. And this last one was really fascinating. The thing driving a lot of these relative value trades is not the demand from leveraged investors. It's the fact that real money investors, they like the liquidity of Treasury futures. And so they're willing to buy those relatively high prices that make it profitable for hedge funds to take the other side and provide liquidity services through these relative value trades. And that, has been a big factor.
Very interesting. So real money investors are getting exposure to being long treasuries by futures because they can get in and out of them very quickly, liquidity. So that is causing spreads between treasury futures and cash treasuries to widen, therefore increasing the profitability of shorting the future and owning the cash bond, the leverage trade. And those people who are harvesting that spread, that is the basis trade. Joseph, right?
Yeah, absolutely. Absolutely. It also does seem like the inventory levels of dealers have trended a bit higher over the past few months. So, for example, when the Treasury issues debt, a dealer has to buy that and hold that in inventory before they can sell it. And it looks like their inventory levels are a bit higher, been trending higher. And in order to finance that inventory, they also need repo financing as well. So that might play a role.
Lou, what would you say the consequences are of the draining of the reverse repo facility? And do you think it will go to truly zero, or it will kind of have an asymptote where it approaches a certain level and then kind of stays there?
Asymptote's probably a good word for this. Back when the Fed originally went to a zero interest rate policy, we pretty quickly found out that ZIRP actually meant getting down to the effective lower bound. And I think there's going to be an effective lower bound for the RRP facility in this episode as well. For instance, if you look at RRP activity now, the Fed on a monthly basis with a lag provides a breakdown of the counterparties that are involved. One set of counterparties that's good for, I think, something like 20 or 30 billion a day is the GSEs, who have accounts at the Fed but don't earn interest on them. And so the RRP facility may be a very effective cash management tool for them. Who knows? Maybe that levels out at the 20 to 30 billion range indefinitely. There may also be some money funds out there that are eligible participants that have idiosyncratic reasons for maintaining RRP exposure. Again, onboarding counterparties is extremely burdensome and expensive. It requires expensive credit monitoring. If you don't have that many repo counterparties, it may be cheaper just to leave a few basis points on the table and settle in at the Fed over time. So there might be money funds out there that end up maintaining a balance even as market rates rise enough to pull all the major funds out of the facility. So I'm guessing that the long-term effective lower bound is somewhere in the 0 to 50 billion range. And I think we're going to get there.
Like gold did, Bitcoin is establishing itself as a macro asset that potentially helps hedge against the government devaluation of your money. Finally, you can easily access Bitcoin in a low-cost ETF with the VanEck Bitcoin Trust, ticker HODL. Search the ticker HODL in your brokerage app today. Visit vaneck.com/HODLFG to learn more. That's vaneck.com/HODLFG. Now the disclosures. Investing involves risk and you could lose money on an investment in the VanEck Bitcoin Trust, also known as the Trust or HODL. The value of Bitcoin and therefore the value of the Trust shares could decline rapidly, including to zero. You could lose your entire principal investment. For a more complete discussion of the risk factors relative to the trust, carefully read the prospectus linked below. Thanks, let's get back to the interview.
Lou, now I want to move on from the reverse repo facility to the another thing, the Fed's Bank Term Funding Program, the BTFP. So it was late in December, and I saw a note from Bloomberg saying Lou Crandall notes that he expects the Bank Term Funding Program to expire in March of 2024, exactly 1 year after it was started, and then exactly 1 month later, in late January, the Federal Reserve did exactly that. So the Bank Term Funding Program now has a little over $160 billion in it. I'm sure a large percentage of that, or some percentage of that, was banks who truly needed it. Of course, need it's hard to define, but some people heard a rumor that some banks were using it as arbitrage they borrow at 460 basis points to harvest a 540 basis point spread or something like that. So how much sort of bank arbitrage was in there, and do you think that contributed to the reason why the Federal Reserve decided to sunset it and not continue, or was it for the reason that the Fed determined it just didn't need it?
Bunch of points here. The Fed last month not only confirmed that it was going to sunset the program, but it actually tightened up the terms unexpectedly and prematurely. They did it about 6 o'clock at night. They announced that the rate on new BTFP loans over the remaining month or two would be significantly higher. They would no longer be below market rates. And thank goodness they did that at 6 o'clock in the evening, because if they had done it at 9 in the morning, it would have been like last call at a college bar. The amount of borrowing done on that day would have been highly embarrassing. So they handled that very efficiently. So they really had to sunset the program. The original terms were deliberately concessionary to banks because they wanted to provide as much support to the system as they could. At this point, there's no justification for rolling under the if they had let it go all the way to March 11th, banks would have been able to continue to borrow at below market rates and with extremely generous haircuts on margin requirements on the loans. And that's just untenable under the terms of the Federal Reserve Act. So it clearly had to go away. But yeah, much of the growth there have been significant growth in November and December that was clearly arbitrage. Now, I would step back and I would say it's not necessarily just borrowing from the program and leaving the money at the Fed. The banks generally, even with as attractive a spread as there was, banks generally don't want to expand their balance sheet that way. The leverage doesn't work out well in the overall capital ratio calculations. The arbitrage here was replacing other forms of funding. So you can borrow at that low rate from the Fed, borrow less in the wholesale market, because banks in general have been continuing to allow very cheap retail deposits to run off, replacing them with medium-term money market wholesale deposits. The BTFP was a much better solution while the rate was still very low. So yes, that's arbitrage, but it's not, the simple T account version makes sense. It's accurate. It's available. I don't think that's specifically what most banks were doing. But at any rate, it was just becoming, frankly, an embarrassment that they were continuing to provide subsidized cash to banks that for the most part were probably healthy. So it really needed to be wound down.
Now let's move on to the Fed's balance sheet policy, particularly quantitative tightening. Joseph, how about you remind our audience and Lou about your view on when the Federal Reserve will start to taper and why, and then let's hear Lou's thoughts.
Well, right now, I think there's a few views on the FOMC as to when to start the QT taper. Now, remember, the process is to first taper first and then eventually end it. That was how the first QT ended as well back in 2019. So right now, it seems like you have one school of thought, whereas people would be looking at, let's say, total reserve levels and saying that when aggregate reserve levels get to around where we think lowest comfortable level of reserves is, get a bit above it, we'll taper and then we'll end it. It seems like recently there is this new group of people who are also looking at the level of balances in the reverse repo facility and thinking that, when the reverse repo facility goes towards zero, we should taper then. Maybe that gives more time for the financial system to adjust. And I think there are also some people who think that we should look at reserve levels plus RP together. And when that consolidated level goes towards our estimate of lowest comfortable level of reserves, whatever that may be, will gradually slow down and taper. So I don't know if there's a party line view on what QT will be. Looks like Chair Powell and everyone is going to talk about that at their March meeting, and we'll find out more details. My best guess is that we would have QT tapering sometime towards the fourth quarter of this year, and I think it could go on much longer than expected. I think there are things happening right now where the Fed is trying to make some adjustments where they can allow QT to run longer than I think the market anticipates. One of these things I think is rather than guess just what the lowest comfortable level of reserves is, they're trying to build in backup facilities just so that in the event that they miscalculate, the banking system can be more elastic. So one of the things that we've read about in Bloomberg is that some of the banking regulators are trying to make the discount window unstigmatized. So what they're trying to do is to force all banks to tap the discount window once a year and basically be operationally ready to use it. This was part of the legacy of what happened last March, where many of the regional banks were not even set up to use the discount window, surprisingly. So if you can get everyone to willingly tap the discount window when they want, whenever they need cash, and of course we have the standing repo facility, then you really kind of don't need to worry about calculating those comfortable level of reserves. You can just let QT run for a really long time. And maybe when we see indicators in those facilities, higher take up, maybe that could be a sign of stopping QT. So that's where I think that maybe we could be heading in the coming months, but I think that's really preliminary at the moment.
I agree with that outline. They are just beginning the conversation. And I think that we will undoubtedly get more FOMC members talking about this after the March meeting. But they've been quite clear that they just haven't addressed this yet. And most FOMC members don't spend a lot of time thinking about the balance sheet unless it's front and center in the debate. It's unlike interest rates that they think about all the time. Their interest in the balance sheet is episodic. I strongly suspect they're not going to start gelling around a consensus on the kinds of issues Joseph is talking about, all of which are going to be on the discussion agenda next month. But I suspect it'll be some time before they start really coalescing. But yeah, they clearly don't see any rush about this. When Lori Logan spoke about this back at the beginning of January, the mere fact that she mentioned the word, tapering QT, or the phrase tapering QT, suddenly put it on people's radars. But she is particularly intimately familiar with this set of issues, and the way she was describing it made it pretty clear that nobody felt any urgency on the FOMC. They didn't think they were close to having to move on this. They've been talking about QT. One of the phrases they like to use about the balance sheet is they want it to be regular, predictable, uninteresting, like watching paint dry. Starting the debate right now about QT tapering, the debate is going to be like watching paint dry. This is going to stretch out at least to the summer. My original call was that they would, at the June meeting, be willing to announce a cutback in runoffs by July. Lori's discussion made it clear that was the very earliest that they could conceivably do that. And developments since then, in the money markets in particular, make me think that the risks are on the far side. I'm not going to, that's such a fuzzy forecast anyway. I'm not going to fine tune it until we start to get some feel for how they're talking about this. I thought and think the July Treasury auction cycle is the earliest point at which we could see an adjustment in the pace of runoffs. But emphasis there is on the earliest. Starting in the fourth quarter wouldn't surprise me. And one of the reasons there is that I thought that the very large increase in bill issuance in February and March was going to add a little bit more to overnight repo rate pressures, and it didn't happen. So that tells you one of the things they have all stressed is that they are going to have a top-down and a bottom-up approach to narrowing in on the right level. And the top-down approach is looking at aggregate reserves against other metrics. Some of them like to compare it to GDP, which seems like the wrong ratio. Things like total bank assets or overnight or daily Fedwire payment volumes seem like more relevant metrics. But getting a general sense of how you would estimate an overall comfortable level of reserves. But then from the bottom up, you actually look at how money market spreads are evolving, in real time. And when you start seeing upward pressure, you're going to learn something. You're going to learn that we're getting closer to the levels where the size of the Fed's balance sheet is beginning to bite. From a top-down level, we're nowhere near an area where you should be concerned. And from bottom-up level, again, money market spreads are going the other way. So no red flags there whatsoever.
One thing, so we just had a speech from brand new Kansas City Fed President Jeffrey Smith just a couple of days ago, and he actually mentioned QT, and he put himself in towards the more hawkish line where he was like, he didn't feel like there's any need to taper QT right now, and he seemed to link concerns of shrinking the balance sheet too quickly with interest rate volatility, and he didn't seem to think that was something that should shape policy at the moment. So there's one new voice there who is, I guess you could consider him to be hawkish on QT, wanting it to run for longer or maybe taper later.
Not unexpected coming from a president of the Kansas City Fed. That's a long-standing sort of intellectual tradition there.
Oh, one last thing that I would add, and like a recent guest on the show, John Kaminsky, he also makes an interesting point that if you look at the structure of the Fed's holdings, like when they roll off, even without any QT taper, over next year, gradually, QT will mechanically stop simply because of the how the maturities are scheduled on month to month. So there'll be more months where the Fed simply won't hit their, I guess, maximum roll-off target. So
Yes,
even without doing anything, QT will naturally taper.
that's a good point.
It's very interesting. I'm going to attempt to establish a few facts for the audience, and I'm at risk of making a misstatement. So if I do, please correct me. So the Fed's balance sheet peaked at just under 9 trillion in 2022. Now it's at 7.58 trillion. So some progress, definitely, well over $1 trillion of roll off, including the bank term funding program. And I believe that when they're doing quantitative tightening this time, it's not they're selling assets; they're just letting them roll off. So when you both use the term roll off, that's what you meant. And the maximum roll off is 95 billion of assets, but that's the maximum, and they're not hitting that every month. In fact, I don't know if they hit that at all, because it depends on how much paper is there to roll off. So finally, I'll say that it sounds like, based on what both of you are saying, whether the Federal Reserve is going to start tapering its balance sheet, which is reducing the roll off from 95 to another amount, until it goes down to zero, it will depend on the lowest common level of reserves, LCLOR. And so that's kind of like one bucket of money. Once this, the level of reserves starts to hit that level, or starts to be close to that level, that's when we'll start to taper. But Joseph, you're saying there are also some that the Fed could want to consider the reverse repo facility. So, actually, it's not just bucket one. We should also count the money in bucket two. So that's interesting. But Joseph, Lou made a point about what he's seeing on the money market front side makes him think that it will be later. What did he mean by that, and why would what he's seeing in the money market front affect the Fed's balance sheet policy?
So I think one of the things that the Fed looks at to gauge what they call reserve scarcity is how money market rates behave. And their experience is heavily colored by the last time they did QT, where ultimately we had some hiccup in the repo market, where in September 2019, repo rates spiked tremendously. And so I think there are a lot of people in the Fed link having not enough reserves in the banking system with volatility in money market rates, be it through repo rates or through other overnight rates as well. Now, Lou makes an observation that in one of the overnight unsecured markets, the OBFR, there actually seems to be a little bit of softness there. And of course, repo rates in general are quite well behaved. So if the Fed is looking at overnight rates as a sign of whether or not they're shrinking their balance sheet too much, whether or not the banking system doesn't have enough cash, well, there's really no sign of that right now. And so that should give them confidence to continue to shrink their balance sheet. So if we see, let's say, overnight rates become more volatile, tick higher as a spread to IOR, that could be more of a sign that people in the Fed would be more concerned about the size of the Fed's balance sheet. Is it getting too small?
Sorry to interrupt. Just want to tell you about Blockworks' upcoming crypto symposium in London, the Digital Asset Summit, which is running from March 18th to March 20th. Everyone in crypto is going to be there, not just the experts and policymakers, but the real industry leaders writing the checks. Over $800 billion in assets is going to be represented. Anyone in crypto is going to be there. So if you're into crypto and you haven't bought your ticket yet, the time is now to get your ticket. I would not wait any longer. We've got some exciting guests on the macro side too, Julian Brigden, Michael Howell, and yes, I can confirm at last the rumors are true. Joseph Wang, the Fed guy himself, is going to be there too. I'll be hosting a panel with these macro heavyweights that you don't want to miss, so be there or be square. Click the link in the description and use code FG10 to get 10% off. Thanks, let's get back to the interview. We have not mentioned at all the one principle which I believe motivated the Fed for a while, which is that balance sheet policy and interest rate policy should be moving in the same direction. Basically, that you shouldn't do QE when you're hiking rates, and you shouldn't do QT when you're cutting rates. But this would still mean that if the Federal Reserve cuts in, let's say, June, that the Federal Reserve would be cutting rates
while it's reducing its balance sheet, meaning the policies would be moving in opposite directions. Lou, is this concern, I think it was called the Bernanke doctrine, is that kind of viewed as passé, like that's not really at play anymore?
Yeah, they've been pretty explicit about this, that the interest rate and balance sheet debates are entirely separate and motivated. They're interrelated, but they are motivated by different factors. The balance sheet, they view their balance sheet policy less as a macroeconomic tool right now than as a post-crisis normalization effort. And so they think it could be entirely consistent to continue to normalize the balance sheet while also normalizing interest rates as inflation comes down. And this gets back to what Joseph was talking about, that they are the September 2019 volatility in overnight money market rates had a big impact on the Fed's attitude toward all of this. And as a result of that volatility, which happened because it turned out that the necessary level of reserves was significantly higher than they had guessed from a top-down perspective. As a result of that, they want to be extremely careful in the way they handle not only the pace of runoffs, but communication about runoffs. But Powell has made it quite clear that the macro outlook at this point, the QT tapering outlook, is driven by liquidity management considerations, and the rate outlook is driven by macro conditions, which means that the nature of the two debates is very, very different. The liquidity management perspective on QT tapering, has a sort of definable timeline. How fast the portfolio will shrink. That gives you some sense of what sort of the mileposts are where you have to be ready to start either thinking about slowing the pace or actually acting on it. And we don't know exactly how that will play out. But again, since it's being driven by a predetermined path of the Fed's securities portfolio, you can make educated guesses about when certain phases of the debate need to be completed. On interest rates, it's entirely dependent on the incoming data. You've seen this week a number of FOMC members talking about the fact that we need to be patient about rate cuts. But at the same time, Vice Chair Jefferson last week pointed out that many of the last 6 easing cycles have played out rather differently than the Fed originally expected, and that history tells us we need to be nimble. Well, a nimble central banker isn't a patient central banker. A nimble central banker is one who's willing to wait until events grab his attention, but then he's willing to move very quickly. And that's where we are in the interest rate debate, that there's no indication right now that that the incoming data will get to critical mass that will require a policy move in the next couple of months. But beyond that, it's completely open-ended.
Let's talk about rates. Lou, in your experience, having experienced many cutting cycles as well as many hiking cycles, how do they differ? I mean, do you expect this cutting cycle to be somewhat a mirror image of the previous hiking cycle that began in early 2022, or are there some things very different about cutting cycles than hiking cycles?
There is something different about every cutting cycle. And this one in particular, we've never been, as Chair Powell likes to say, we've never had a pandemic in the modern central banking era. It's actually an important point about thinking about business cycle developments right now. The whole debate over whether we're going to have a recession or not over the past couple of years has been really unproductive in a lot of ways, because the presumption is that we know what a recession is and how it behaves and what this progression from stage 1 to stage 2 to stage 3 is, and then what the recovery looks like, and getting back eventually to an expansion. We've got these nice, neat categories which have held up over time because they tend to apply reasonably well to most cycles. But this cycle has been unlike any in my lifetime. If you had told me with certainty a year ago that we were absolutely going to have a recession, I would say fine, but I don't know what the recovery looks like. It's entirely possible that coming from the elevated level of activity that we had in many sectors, that you'd have a recession, and then all of a sudden you'd be back to trend, and you wouldn't expect a significant rebound. It would have depended on how that slowdown had actually, you know, evolved over time. But there's no natural progression in any of this right now. Again, very open-ended.
Yeah, very, very open-ended. Joseph, what are your thoughts on the forthcoming interest rate cutting cycle? Likely it will be cuts. In mid-February, you wrote that just because a lot of the Fed interest rate cuts that were priced in at the beginning of the year, I think 6 to 7 cuts were priced in for the year of 2024 in January 1st, let's say. Now it's only 3. So you say just because the cuts have been moved back in scale and in when they start, that doesn't mean that the cutting cycle won't occur. And you reference many public utterances by Federal Reserve officials to explain why you think that. Tell us about that.
Yeah, so I think Lou is absolutely right that every cycle is different. I'm guessing Vice Chair Jefferson maybe looked at some of the past Fed forecasts for, let's say, maybe the last 20 years and realized, my gosh, we're always wrong. I have no idea what we're going to do. So I think this time, though, there's good reason to think why the coming years are going to look very different from the years before. I mean, we have 2 big structural things that we haven't seen before. One of them, of course, is demographic. We have an aging population. For all of the history of our country, we've had a workforce, working age population that's been steadily growing. But because we had smaller families in the 80s, our workforce today is just not growing in the same way it used to. And so that suggests that labor market will be structurally stronger. So there's going to be more concern about insufficient labor than there is for insufficient demand for labor. Second thing, of course, is that the fiscal side is very different now than it is before. Before we had, I guess, more fiscal restraint, but now the CBO is thinking that based on current law, we're going to have structurally large deficits for the foreseeable future. So I think these two factors make it hard for me to see how the economy would be weak. It seems like this continued strength we see in labor markets and in nominal growth is something that has strong structural reasons behind it. So I'm not really too worried about the economy. But to your point, Jack, the Fed officials, regardless of what we see in the economy or in the markets, they're quite resolute that they want to cut rates. We've had affirmation on that point by two important people in the Fed. We've got John Williams with an interview in Axios last week. Just basically, the title gives it away. He's still thinking about cutting rates sometime later in the year. Governor Waller still seems to think that way as well. And that's because they look at the world through the lens of both real rates and R-star. And real rates, what are real rates? It's nominal rates minus expected inflation. And expected inflation has gone down a lot. So, unless they cut nominal rates, we're going to have real rates gradually rise. And that could risk over tightening, especially when they think that the neutral rate in the economy today is the same as it was pre-pandemic. So that framework, I don't know if it's correct, but that seems to be how they view the world. And that is consistent with cutting rates later in the year, which is also what they guide in their dot plot and in their recent speeches.
As inflation falls, with the nominal rate staying the same, the real rate, which is the inflation adjusted rate, is going to rise. Joseph, I think you just said that their estimate for the neutral rate stayed the same. You've got a very interesting chart, which we can put up from your second to most recent piece on fedguy.com about the FOMC neutral rate estimates showing the median and then 25% and 75%, I guess, percentiles. And it showed that rate actually did jump up a little bit over the past year or so. Can you explain where that data is coming from and what it means?
Yeah, it's from so every quarter there's something called a dot plot where it's what everyone else calls the dot plot, because everyone focuses on the dots. Well, basically everyone on the FOMC puts down where they think, let's say, monetary policy, employment, inflation will be for the next few years, but they also put down where they estimate, let's say, the non-long run neutral rate will be. Since we know that in the long run, they assume that inflation will be about 2%, so you can infer from their long run neutral rate where they think the R-star long run neutral real rate is. You don't get exact dots, but you get percentiles to get a sense of where the committee is. And you can see that the median is solidly 0.5%. And as you know, Jack, over the past few years, it seems like the distribution has slightly tilted upward. And I'm guessing that a lot of people were looking at the economy. Hey, we hiked rates to 5.5%. Everything still seems fine. Maybe policy is not as restrictive as we thought it was. And so they adjusted their R-star measures upward. But even with that slight upward drift, you can see that most people still think R-star is about 0.5%, the same as it was before. And you can hear speeches from John Williams, president of the New York Fed, who would just tell you that that's what he believes. And he's a pretty influential person there. So it doesn't seem like they think that there are structural changes in the economy that would affect how effective monetary policy is. Even though it seems like there's a lot of evidence that really monetary policy is really not as restrictive as they think it is. But yeah, if that's what they believe, then they got to cut rates in the coming months.
Got it. So I gather, Joseph, that what do you say, the 25% to 75% percentile, that's just based on the distribution of the dots?
Distribution of the responses. So they don't actually give you their individual dots for that particular category. They just give you the 25 median and 75 percentile.
Thank you. Lou, what do you make of the argument that potentially the neutral rate could be higher than in the past, the neutral real rate higher than 50 basis points? Because, I don't know, there aren't enough workers, or because fiscal stimulus is so large, whatever the reason. How do you think about that argument?
We've never had much luck in predicting the neutral rate. Neutral is as neutral does. And if you look at the kinds of metrics that Joseph was talking about, you go back to the early years of the dot plot exercise in the Bernanke Fed, and the neutral rate, the estimated neutral rate, stayed relatively high, even years after we had all adopted the phrase "the global glut of savings," which had driven down real equilibrium rates. Well, the thing about the neutral rate is that it really is the evolution of the neutral rate over the last quarter century is really critical to understanding the evolution of macro finance. That we had the global glut of savings that surprised everyone initially, and it meant that the Fed always thought the policy was tighter than it actually was. But when people finally began to adjust their estimates after the global financial crisis, it took years to get down to the current equilibrium that we have. But the revisions to FOMC expectations were massively directional. And I think I don't know where they're going to go in the next couple of years, but once they do start rising, I think they're just going to rise quarter after quarter after quarter for a period of time. If in fact it turns out that, as I've said earlier, neutral is as neutral does. We'll find out from, in the years ahead, where we think we need to be. But the Fed's response historically has been extremely sticky, and that's probably going to be the case again.
I really like Chair Powell's comment where he says, "We will know it by its works." It's a very good practical way of looking at it. I hope he sticks to it and doesn't get bamboozled by those fancy models that don't work very well that other people may have.
Yeah, just on that point, this gets back to the discussion about how they're going to think about the balance sheet. They've got top-down estimates based on long-run productivity growth and things like that. And then they've got bottom-up estimates based on what they actually see in the real world. And under Chair Powell, they've paid more attention to the bottom-up than the top-down.
The final question I've got, the final topic to address, is one for you, Lou. I was very surprised to read in your money market note with right in ICAP, which is excellent, about a potential government shutdown. I did not know that was on the table. How seriously should we take this, and what do you think the disturbances it could be to the society as well as the money market complex? Because as you so often know, the news media says government shutdown, blah blah blah, and it never happens. Very often it is the dog that maybe doesn't even bite and maybe it doesn't even bark. So tell us about the cause of this and how significant you think it will be and how it plays out.
Congress has been highly unpredictable, and the legislative process has been chaotic to an extent that I've never seen before. And so I don't know how this is going to play out, but it is not in anyone's interest in Washington on either side or in either house to have a shutdown. So there ought to be a way to resolve it, which is why in most cases, we've had one shutdown threat after another since last fall. And the can has gotten kicked down the road, quite effectively, usually with a lot of airtime until now. But at this point, the issues involve the fact that it's been tied up with national security issues that are extremely contentious. Has a lot of people back themselves into corners, and it's just not clear that they're going to be able to get it done in time to prevent either the first wave of shutdowns this Saturday or Saturday, March 2nd, or the following Saturday. But one of the reasons, we have debt ceiling crises all the time, and we haven't in recent years had a default. We do have shutdowns on a semi-regular basis. We haven't had one since 2019, but that's not that long ago. And the reason is that shutdowns generally are not that disruptive at the aggregate level. They're extremely disruptive to families and businesses, but you don't see large repercussions in the macroeconomic data. They're definitely bad. They're bad for confidence. They can slow down productivity growth because government agencies actually do a lot of good stuff, and slowing down permitting and other government approvals can be a real problem for businesses, but problems that they work around that don't really move the needle much on GDP in any given quarter.
Another point you have is you're looking at the outlays or inlays to the IRS and the Treasury. Tax season is approaching, so government's getting in a lot of money, but of course it's paying out money in terms of refunds too. I know you had a projection that you thought that taxes would come in maybe, I think you said 5% higher than they did in 2023.
That number was for refunds.
Okay, refunds.
That are base case for the refund season, which just got underway seriously last week. $46 billion went out the door on last Thursday. Our guess for the season as a whole is the refunds will be up 5%. However, it's much too early in the season to extrapolate from the early processing data to be sure about that. And swings in that number, which is just under $300 billion, that can have a big impact on Treasury bill issuance and technical issues at the front end of the money markets going through the April tax season.
What are the impacts? What are the factors that impact the rate of change of the refunds? I mean, I imagine if wages go up 5%, then refunds will go up 5%. Is it just that, or are there other factors?
Well, there are lots of factors, and a lot of it has to do with things like job hopping can create additional refunds if people were taxed at different rates in two different jobs over the course of the year. But just with all of the tax credits that have come and gone since the pandemic, the structure of the federal tax system has been so volatile that it's very, very difficult to have any confidence in projections of any of these things. And it's, the fiscal data in general are probably going to become increasingly high profile in the months ahead, because we're beginning to get enough monthly information to gauge how both tax revenues and outlays are shaping up relative to CBO's projections. In my case, and the case of most people in the private sector, our fiscal projections are very short-term in their extrapolations of visible trends. And those visible trends depend on normal seasonality. There has been nothing normal about the seasonality in government outlays since 2020. I mentioned a $46 billion batch of tax refunds released last Thursday. That compares to the all-time peak of $150 billion that went out on a single day in April of 2020 due to the government's, the economic impact payments at the beginning of the pandemic. Those things introduce, to use a term of art, a certain amount of noise in the historical patterns that makes life kind of challenging.
Definitely. Joseph, you've done a lot of work on sharing your view on why increased U.S. fiscal spending will have an impact on the macro economy. You had your most recent piece out is on that called recycling money. Just I'll give you the final word about sort of a structurally large fiscal footprint and how it's going to impact the economy as well as financial markets.
A big part of the macro view going forward, from my perspective, is that we're going to have a structurally large fiscal deficit. Now, we've always had large government spending, but I think financing, how it's financed, makes a difference on its macro impact. For example, if I'm financing my spending through taxation, what ultimately happens is that I'm taking purchasing power from someone, so the taxpayer, and then spending it, and so giving money to someone else. Now, at the end of the day, the taxpayer, the one I taxed, has less money to spend. But when I'm spending and financing it through debt issuance, there isn't an impact like that. So the investor gives me money and I give them a treasury in exchange. And so from their perspective, their purchasing power is unchanged. So I think that the macro impact on nominal GDP from deficit spending is going to be large. And I think we see impacts of that happening right now. And that's something that hasn't happened before. It looks like it's going to be increasingly important. And I'm not sure that many people appreciate how fundamental that is to what we see right now in the economy.
We'll leave it there. Lou, Joseph, thank you so much for joining us. And thank you everyone for watching. People can find Lou's work at wrightson.com and Joseph, you write at fedguy.com. Thanks again.
I'll just add one more thing. So Lou's publication is top notch. When I was at the open markets desk, everyone read it. So if you guys are institutional investors, can definitely check it out.
That is high praise. When the Federal Reserve reads your stuff, that's high level.
Thank you very much.
Thanks for watching. Remember to check out vaneck.com/HODLFG to learn more about the VanEck Bitcoin Trust, ticker HODL. A reminder that forward guidance episodes are available on all podcast apps and on Twitter, where I post them regularly at JackFarley96. Thanks again. Until next time.